Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to the 97th episode of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. As you can tell very quickly here, Mark is unable to record the podcast this week, so we have Aaron Kramer as our guest host this week. Aaron is our wealth advisor, a part of the Jessup Wealth Management family, and I'm very happy to have him with me this week. Welcome, Aaron.
I'm excited to be here.
I'm happy to have you. This is going to be a good one.
It's going to be a great one.
We got some good content.
Absolutely.
So, as always, before we start, let's take a few minutes to recap the performance for the month and the year to date for all the major indices that we track, Aaron, for the listeners. These numbers are going to be as of the market close on May 11th, and this data is from stockcharts.com. The S&P 500 index for the month, down about 2.84%. For the year, up 8.8. The Dow Jones Industrial Average for the month, down 0.85. For the year, up 9.74. For the NASDAQ Composite, down 6.67% for the month and up 1.11% for the year, barely keeping its head above water there.
Barely.
Yeah, barely. The IWM ETF that tracks the Russell 2000 Small Cap Index for the month, down 5.79%, and Aaron for the year up 8.26 still. The Vanguard International ETF ex-United States for the month down about 2.38%, for the year up 8.17. And then let's give an update on Treasury bond yields. So Aaron, on the 3-month, the T-bill sits at 0.015, barely positive.
Barely.
The 2-year Treasury sits at 0.167. And the 10-year, pretty relatively unchanged since the last podcast. It sits at 1.69%. Okay?
Very good.
So before we dig in, I'm going to discuss big news headlines and current events for the week. I'll dig right in. We'll start first with April employment data. So the BLS employment data for April was a major disappointment, Aaron.
It was major.
Major. The data released last Friday showed the economy adding 226,000 jobs, again for April, versus economist expectations of 1 million new jobs, and with prior month's figures being revised down as well. The unemployment rate, expected to fall, Aaron, to 5.8%, instead rose to 6.1.
Very interesting. Why do you think that is? Just curious on your opinion.
I think it's the participation rate I read.
The labor
so
force.
You're having people, in essence, retire, leave the labor force, and it's affecting these numbers.
I agree. Yeah.
Expectations were lofty as the economy continues to reopen as more people become vaccinated and restrictions are eased. The weak data was attributed to enhanced unemployment benefits, making it harder to lure workers back as job openings remain very, very high. The current number of jobs is approximately 8.5 million lower, Aaron, than pre-COVID.
Wow.
Pre-February 2020 levels, to be specific. Last month, 18% of all employed persons teleworked because of the pandemic.
Interesting.
Now, that data, again, came from the government.
Right.
The Bureau of Labor and Statistics, BLS. How in the heck do you think they got 18% of employed people are still teleworking? How do they know that?
I think it has to be from polls, but I don't know how accurate that can be.
I know.
It's interesting.
We know if Mark were here, we know how Mark feels about polls.
He does not like polls.
He doesn't. If you want to poke the bear, reference a poll. Yeah. Remember that for the future.
I will.
Okay. But labor shortages were widespread around the country. This is the second item I want to share from current events and news headlines. So again, labor shortages widespread around the country. Check this out, Aaron. I know you heard this. Montana, South Carolina announced that they are ending their participation in the expanded and raised unemployment benefits that are effect through the end of June now.
Wow.
The American Rescue Plan makes the aid available through September 6th. The programs, in place since March of last year, pay funds to the long-term unemployed, offering a weekly $300 supplement to the benefits. The governors behind those two states, Aaron, they blame the unemployment programs for keeping workers home and causing the labor shortages.
I tend to agree because
I would agree.
I think people aren't incentivized to go out and find work when you can get an extra $300 a week.
In some instances, they're making more than they would normally.
Absolutely.
I've heard of those
I
examples.
have as well. So I think once that $300 a week goes away, I think we'll see a more accurate representation of the unemployment rate.
I would
in my
agree with
opinion.
that. Do you think more states, Aaron, might come on board after Montana and South Carolina?
I think they will, especially as the vaccines continue to roll out. I think they have the cover to do that because it's, let's say, in quotes, safer for people to do that and get back to work, in my opinion.
Yeah.
So I think states might follow other ones.
I mean, everywhere you go, what's the sign you see before you walk in the door? Need
Now
people.
hiring.
Now
Yep.
hiring.
They'll put the wages right on there too, and it's they seem relatively high in my
And there's
opinion.
bonuses at places.
Exactly. There's sign-on bonuses, all that kinds of stuff. So.
Absolutely. Two more major headlines for listeners, Aaron. Next is Treasury Secretary and former Federal Reserve Chairlady Janet Yellen acknowledged in an interview released last Tuesday that interest rates may need to rise somewhat to prevent the economy from overheating. If and when the administration does additional spending, if that becomes a reality. Multiple Fed speakers were heard from over the past week, and most were consistent in their message, though, that Federal Reserve policy should stay accommodative, though, for some time. It's too early to talk about tapering asset purchases, and inflation pressures are likely to be temporary. Any comments there?
No, it's interesting. I think that kind of points to a lot of these commodities being at such high prices. And I think inflation is going to be a big topic over the summer. Whether the Fed decides to raise rates over the summer, I think is anyone's guess. But
Sure.
I think it's going to be a hot topic right now.
I would agree. I think there's going to be a lot of hyper sensitivity to any sort of data that's inflation related.
Right.
Yeah, a good way of saying it. And the last item for news and headlines is more and more Americans are investing in the stock market. So I got some numbers behind it, Aaron. According to Bespoke Investment Research on May 10th, quote, back in 2014, roughly 40% of survey takers who said they were invested in the market said they follow the market on a regular basis. This reading has steadily increased over the last 7 years and hit a record high this month of 75.8%.
That's interesting. That's a huge bump.
Who would have guessed that?
I don't know.
That's a huge stat.
I wonder what the underlying reason is. Do you think it's news coverage, media coverage?
I think a lot of people have said people have invested a lot of their stimulus checks into the market. You know, you have a lot of these. It's an easier path to open up an account these days than it has been in the past.
Right, that's true.
Right?
That's true.
Last part is the percentage of consumers that say that they're investors has spiked significantly as well. Rising above 50% this month for the first time since the early days of the survey going back to late 2014. So again, more eyes on the market. I think it's a good thing, not a bad thing.
I agree. I think it's good that the retail investors sort of, even if they're not doing it well, at least they're thinking about it and
taking control of their personal finances.
Exactly.
Right?
Yeah, it's great.
I wanted to share that, and I thought the listeners would like to hear that. So let's transition. We're going to go over tweets, articles, and research that caught our eye over the past week. I know on all of our social media sites, Jenna on our team posted all the show notes.
Yes.
So for those of you that do not follow us on social media, if you visit our website at www.jessupwealthmanagement.com, you will see the links to all of our social media sites, things like Facebook and Twitter and LinkedIn, etc. And you can get the links to these show notes. So if it's okay, Aaron, I'm going to let you start.
Yeah, we'll jump right into tweets, articles, and research that caught our eye over the past week. So the first thing I saw was a little research article put out by Bespoke Investment Group. And it's a chart on elective surgeries. And elective surgeries are typically procedures like plastic surgery or LASIK, things that you would pay out of pocket for that insurance might not necessarily cover.
Got it.
So when times are tight, elective surgeries tend to get put off. And when consumers have cash on hand or are flush with cash, that's when consumers tend to have these surgeries because they can afford to do so.
It's elective, it's a luxury, etc.
Exactly. So this survey below shows a massive spike in cosmetic and plastic surgeries. And this chart goes back to November of 2014 and all the way up through November of 2020. And cosmetic surgeries bumped to almost 10%, or a little over 10% actually, which is just huge.
Huge.
Maybe I'm speculating, but I think it's a lot of the stimulus flowing through the economy, and I think it's a lot of the backlog of demand over the pandemic where people couldn't get these surgeries done because surgeons weren't offering them, or they didn't feel comfortable taking that risk and going out and getting it done. What's your sort of opinion on this?
I'm glad you kind of brought this topic up overall, because underlying it says one thing to me. The underlying strength of the American consumer is strong.
Yeah.
Because he or she would not go out and do these procedures if they didn't feel financially stable to do so.
Right.
So that, first and foremost, underpins the strength of the consumer. You know, the other area is, I can't name the specific company,
right,
but there is a stock that is currently in our internal model that kind of benefits
directly from this.
Elective surgeries.
Exactly.
And so there are ways, listeners, that you can kind of play off some of this data. But I think the bigger theme is it tells me the underlying consumer is strong right now.
Yeah.
And I'm glad you brought that up, because people aren't going to go out and spend $5,000 on a plastic surgery if they don't feel financially comfortable.
Exactly.
Whether they're paying cash or they're financing it,
they're still not going to do it either way.
They're still not going to do it unless they're comfortable. That bodes well for consumer spending.
I agree.
Okay. That's just my 2 cents.
Yeah. And it overlays the chart with cosmetic, orthopedic visits, and LASIK. So it's kind of interesting.
That is interesting. Well, again, listeners, you can find this on our social media sites if you want to see this exact chart that Aaron is referencing.
Perfect.
Back to you.
I got another one for you. It is a travel update, again, from Bespoke Investment Group. And it's across all major online travel booking sites. It shows that new highs for booking flights and booking hotels were reached in April. So kind of Expedia is leading the group here on this chart. So it shows, again, from April of 2015 all the way up through April of 2021. It kind of shows that travel was kind of pretty consistent, bouncing back and forth throughout those years. And then it has a huge dip over the pandemic. And then again, it spikes huge, even beyond pre-COVID levels. So I think that's a really, really good sign for the consumer. And I think it's a good sign for airlines and hotels that we can hopefully start getting back to normal from their sort of revenue streams as well.
Yeah, I mean, it says by the chart here, it shows Expedia, Trivago, Priceline, Kayak, and Orbitz are the sites that it has the raw data from going back to April of 2015.
It's great. I think it's a really good sign for the consumer, in my opinion.
I would agree. I mean, again, people aren't going to spend on travel. I've been saying now for months that if anybody anticipated making a trip over the summer or the fall,
book it now.
Get ahead of it. These prices are only going to get more expensive. You know, these airlines, Aaron, they can't turn on a dime and put people and planes back in service.
Yeah, especially with the 737 MAX still being out. So I think there's going to be a lot of pent up demand and a small amount of supply for these flights.
The one thing I did hear, my brother's a pilot for Southwest, and this is public knowledge. He said that the 737s that have been affected haven't been like across the board. It's a subsection of the 737 MAX that still has a wiring issue.
Got it.
But he kind of made the insinuation to me that was more of a minority type of thing rather than like all MAXes. But, you know, the big point, and a lot of people in the aviation industry know this, when an airline wants to put back planes into service,
it's not immediate.
It is not immediate at all. And so you now have capacity constraints, and what happens with the supply and demand metric, prices are going to go up.
Exactly.
There's only so many seats that they can fill. So I'm glad you brought this up because, again, going back to the elective surgery update, are there names that people can own that could potentially profit from this? Of course.
Absolutely.
But there's also, I look at it again, as you said, the underlying strength of the American consumer says, in my opinion, they're coming back and they're spending.
Exactly. That's great.
Yeah. I got one.
Great.
I'll go next. So I have an update on inflation estimates. Now, before I begin, inflation's a hot topic right now, Aaron.
Yes.
Right? I mean, you and I had several conference calls today with clients, and what was a topic that came up every time?
Inflation.
Inflation, right? People are seeing it in lumber, copper, metals, energy, food. They're
Just
seeing
about every commodity there is.
Exactly. So this piece of research was from Compound Advisors Research on May 7th. They said there's one definition of inflation that seems most applicable to today. Quote, too much money chasing too few goods.
I think that's a perfect description.
And you had the bottleneck issues from last year of supply disruptions from COVID where, let's just say factories were shut down, mining operations were shut down. And now that things are reopening, everybody wants it yesterday.
And the consumer's flush with cash.
And they're paying up for it, right? So we are seeing the impact of trillions of dollars in stimulus, money that's chasing a limited supply of goods almost everywhere we look. Now, Aaron, I've seen posts of 2-hour lines at luxury retailers such as Louis Vuitton and Gucci at a Texas mall. Could you imagine wanting that product so bad that you would wait 2 hours just to buy it?
Personally, no, but I think it's a great sign for the consumer, again, that people are wanting these goods and they're willing to wait for them. And these are not cheap goods by any means.
No, and they've drastically got more expensive. I mean, I remember I got my wife a Louis Vuitton purse. The last one I got her, this is probably over 5 years ago, and it was expensive. Mm-hmm. If you looked at the prices now,
more than doubled.
More than doubled in 5 years.
It's crazy.
And people are paying this. Insane. All right, I have other examples for listeners, Aaron. Ready?
I'm ready.
U.S. housing prices are booming. We've talked about it a little bit before on the podcast. They're at record highs nationally, and they're showing the highest rate of increases at plus 11% year over year. Okay, that's the highest rate since 2006.
Wow.
Okay,
wow.
I got more. The used car market is the perfect example of too much money chasing too few goods. You ready? Prices of used cars have exploded to the upside, increasing 26% this past year.
That's huge.
It's
huge.
massive.
Massive.
So I'm going to give you some real insight here. I recently went on a trip with some friends, and I met a new couple on this trip. And the gentleman in this couple owns a used car dealership in town. And one of his problems is getting inventory.
Wow.
And he's like, listen, I have to be very specific at what I sell cars at because it's easy to sell a car now. But here's my problem. I have a problem replacing the inventory.
Wow.
And so, he's in a position to where, if those prices turn and he's got a bunch of inventory on his lot that he's paid excessive prices on, it's almost like a game of chicken.
Right.
When are those prices going to drop? And, a lot of used cars lots are in these situations. But the demand, he says, is through the roof.
Wow.
Through the roof. One more area. You ready for this?
This one's crazy.
Collectibles. All right. A mint Michael Jordan rookie card that sold for under $15,000 in the year 2015 hit a value of $50,000 in April of 2020, $90,000 in May of 2020, and over $200,000 in December of 2020. Earlier this year, that same card was sold for more than $700,000. You're seeing, and all this data is from Compound Advisors from May 7th, Aaron. And if you're telling me that there's not some potential overheating in some of these speculative collectible areas,
you're crazy.
You're crazy. Okay. So let's make this relatable for listeners. The current 5-year inflation rate estimates, they currently sit at plus 2.68% annually for the next 5 years. I have a chart from Compound Advisors going back to January of 2009. This is the highest forward-looking rate of inflation we've seen in over a decade. And why is this important? I want to make this comment first. I want to get your response.
Yeah.
Here's the silent killer for people that have excess amounts of cash on the sidelines. Loss of purchasing power.
Exactly.
Your comment.
I mean, that's a great point. If you're sitting in cash and you're essentially you're not earning anything right now, and then the price of goods are raising 2.68% annually, you can't keep up with that rate of inflation, and essentially you're losing money on the value of your portfolio or your cash, and you can't afford the same level of goods you could, let's say, 5 years from now.
That's right. And so, people might not see it in their bank statement. Their bank statement might not go down.
Right.
But in 5 years, that $100,000 might only really be worth $90,000.
Exactly.
Right.
Exactly.
And so I want to kind of call it the silent killer that people really aren't paying attention to. And that 2.68, some people look at that and say, well, that's completely false. Because when I go to the store now, that carton of milk, instead of being $4, is now $5.
Right.
The carton of eggs is $1 higher. Gasoline's higher. And if I'm the Federal Reserve, this is my opinion, they have to look at inflation being a tax on the poor.
Exactly.
Because wealthier individuals, they can afford the dollar more of milk. And so there's people in America that this is really affecting.
Right.
And this is something I think the Fed needs to be hypersensitive to. Because it is affecting part of the American population, and that part of the Fed's mandate is to keep inflation under control.
2%, yeah.
Something to throw out there.
That's a great point.
Anything else you want to say regarding that?
No, I think you covered it well.
Before you go, I got one more.
I'm ready.
You okay with that?
I'm ready.
All right. I got an update on sell in May and go away. So in highlighting Mark, last week, Mark brought up the old Wall Street adage or saying, quote, sell in May and go away. So let's do a reminder, Aaron, of what this means for listeners. So this theory is that stocks don't perform well between May and October during a calendar year as they do the other months. So investors who believe in this strategy sell their holdings and park the proceeds in cash for 6 months to avoid downturns. Then they buy back in November and they remain invested through April when the markets have historically tended to do better. So it's simple in theory, Aaron, but it is neither sound nor profitable. According to Advisors Capital, over the past decade, this maneuver only worked out once in 2011. But those who continued to follow the sell in May strategy missed out on some positive, better than cash returns in each of those other 9 years. Now, I have a chart here that I'm about to verbally reference. And again, this is on our show notes. It's on all of our social media sites. Jenna put it up there for everybody. And it shows the average returns of the S&P 500 index over those years, including the one that was negative of 2011. The average from the May to the October was 4.9% during those months. So it kind of torpedoes the whole sell in May.
Exactly.
And go away.
You would just miss out on almost 5%.
Each year. And so isn't it amazing all of a sudden you start putting some data behind this stuff and it kind of just blows up the narrative?
Yeah.
And again, not to sound old, but when I got started in the industry, there were people that thought of this strategy and were almost biblical about it.
Wow.
Yeah. I just don't know. Obviously, the data is telling me it's not applicable anymore.
No. And even in theory, it's timing when to get out and when to get in. And then you're out of the market for 6 months every year.
That's right. It's going to be feast or famine. And obviously, you've seen famine by doing it.
Yes.
I'll send it back to you before the financial planning topic of the week.
Yeah, this last one's an interesting stat. It comes from BBC News, and it's on birth rates in the U.S. And according to the CDC, the American birth rate fell for the 6th consecutive year in 2020, with the lowest number of babies being born since 1979, according to a new report. That's a long time.
The lowest number of babies born since 79.
It's interesting. It goes on to say that some 3.6 million babies were born in the U.S. in 2020, making a 4% decline from the year before. The slump was seen across all recorded ethnicities and origins, according to the findings. So it's pretty crazy. It's affecting everyone.
Didn't affect
equally.
just one ethnic group or anything like that.
It's very interesting. I think a lot of it has to do with just U.S. culture now, and people are waiting longer and longer to have kids, in my opinion.
I think you're seeing also the millennial group, in my opinion, is a lot more methodical. They're planning things out. They're not just hey, it sounds good to have a baby today. I mean, I'm not seeing that type of laissez-faire attitude about it.
Exactly. I agree. It goes on to say in 2020, the general fertility rate in the U.S. was about 56 births per 1,000 women, the lowest rate on record and about half of what it was in the early 1960s.
Wow.
That really doesn't sound like a lot to me. The report also analyzed the total U.S. fertility rate, which estimates how many babies a hypothetical group of 1,000 women would have over their lifetime based on actual birth rates. And for a generation to exactly replace itself, the number has to be at or above 2.1.
And where is it now, you think?
It looks like it's sitting right at 1.7.
So we're not even being able to replace. We're not keeping up.
Exactly. So it's interesting. And experts say the country's tumbling birth rate is closely linked to the average age of American mothers. So kind of what we were thinking. Women are becoming mothers later in life, a phenomenon tied to increases in educational attainment, growing labor force participation, and delays in marriage. So I believe all that. I believe all that goes with the millennial narrative that women are participating in the workforce more, they're getting educated more, and all that stuff is just sort of delaying having children, which I guess is a good and bad thing.
And there's a lot of methodical planning
exactly. So according to Pew Research Center, the average age of mothers at first birth is 27 this year, up from 23 in 2010. So that's a big jump. That's a big change.
That's a big jump in a decade.
It's very, very interesting.
Well, when you say this, here's where my head goes. Longer term, this is going to be a headwind for companies' profitability because they're going to have less people to sell goods and services to.
That's exactly right.
So how is this relatable? And so one of two things have to happen. Either Americans need to start having more babies to keep up with population growth, or we need to have a different immigration policy.
Yeah, exactly. And it all kind of plays into our consumption economy as well, because if there's less people consuming, how do these companies afford to keep up with their same business models?
Well said. I mean, 2/3 of our economy is consumer consumption based. And if you have a population that's decreasing, that could be a headwind for profitability of these companies that provide the good and service.
Absolutely.
So again, either I guess what I'm trying to say also is I don't see millennials right now changing this narrative anytime soon.
I don't know about the next generation. Was it Gen Z?
Is that what it is?
I think so.
Jenna,
I could be wrong.
Do you know what the next one is? Gen Z? Okay. All right. So, I mean, I don't know what their attitude is towards it.
I don't either.
But either that or we're going to have a different immigration policy.
Exactly.
Because we can't have this reminds me of Japan.
Exactly.
They've had demographic challenges like this. And look, it's made their economy stagnant.
It has. And I'm curious what the average workforce age is going to be down the line. Because I wonder if it's going to have people working longer or not.
That's a good point as well. It's a good point as well. I mean, with individuals waiting longer to have children, I think that's also making them have less.
Exactly.
Right?
Yeah.
Rachel and I joke, if we would have had our number 3 baby first, we probably wouldn't have 3. I'll leave it at that. I think listeners will understand where I'm coming from. I love her to death. But if she were our first, we wouldn't have had another 2.
It worked out for a reason.
We may have had one more. Of course, God gave us Rowan first, so of course we had more. But I'm digressing. All right, so let's transition, Aaron, to the financial planning topic of the week. This week, I picked an interesting topic, okay? I selected a blog post from NerdWallet, and the title of the article is, quote, "Ordering the Combo, Life Insurance with Long-Term Care Benefits."
This is an interesting one.
I thought this would be a good one because we are starting to hear more questions from our clients about how they're going to tackle long-term care cost in their retirement.
Right.
Okay. So I'm going to highlight some different areas of this article, and you just pipe in whenever you want to add something.
Will do.
Sound fair?
Sounds great.
All right, let's dig in. So article was written again and posted to NerdWallet. And the first part is, quote, "The biggest risk of buying long-term care insurance is that you might spend tens of thousands of dollars on something you don't use. Policies pay for nursing homes, assisted living, or home health care. But what if you never need these services? New types of policies combine long-term care insurance with permanent life insurance, such as whole life or universal life. Okay? I'll continue. How these combination policies work. Combination long-term care life insurance policies pay for long-term care that regular health care or Medicare will not cover. And if you don't max out the long-term care benefits, the insurer pays the remaining benefit to your beneficiary upon your death. This is also called linked or asset-based policies. Okay. Mm-hmm. Anything you want to add so far?
It's very interesting, and it seems like a good way to protect assets from long-term care, and also kind of a nice generational planning strategy as well. If for some reason you don't go into long-term care, all those premiums that you paid, and they're hefty premiums for long-term care, wouldn't necessarily be for waste, and there would be some investment gain. I'm assuming is how these policies would be structured as well.
Sure. I mean, I guess, and you put it perfectly, and I guess to summarize it, what comes to mind when you were talking is this. It turns it into if insurance to when insurance.
Right.
So if insurance is like our car insurance today, our home insurance, if something happens.
Right, you use it if you need it.
If you need it. And what you're kind of insinuating is it turns it to when. Mm-hmm. It's not a matter of if you're going to get money out of it, just a matter of when.
Exactly.
I think that's a good way of throwing it out there.
Yeah, for sure.
So let's talk about how these policies work, and this is all a part of this blog post from NerdWallet. First, the policy provides a pot of money for long-term care that's equal to several times your premium payments. Okay? Another idea is you can take old cash value in an old policy, and you could upgrade it to one that kind of has this combo long-term care feature. I've seen people do that.
Yeah.
Okay? So no matter which one, the policy death benefit will be reduced, which means less money for your beneficiary according to how much of the long-term care benefit you use. Some policies guarantee a small percentage of the full death benefit, such as 10%, even if you use all the money allocated for long-term care. So in that example, let's say you have $100,000 pool of money you can use for long-term care. You go into a facility, you're older, you use it all. In this example, your beneficiaries would still be left with $10,000 of a death benefit.
Exactly.
Right? Next, you'll need to supply medical records and take a medical exam to qualify for some of these types of policies. Others, though, offer simplified underwriting, which means you only need to answer health questions over the phone. If you're healthy, you'll pay less for coverage if you buy a policy that requires both an exam and a submission of medical records. Okay? So next thing. Sales of these combination long-term care life insurance policies have taken off. More than 260,000 combo policies were sold in 2017, up from 15,000 of these back in 2007.
Wow. Yeah, I think that kind of directly plays in with the rising cost of healthcare, because nursing homes are healthcare, and if it continues to rise at 6-7% annually, I think there's going to be a lot more need for these long-term care policies.
I absolutely agree. I mean, look at the cost, the inflation rate of this stuff.
Right. And maybe an interesting thought is, how can these insurance companies continue to cover these long-term care costs when health costs are rising at this rate? Do you think they just bake that into the price? Or
that is a great question, Aaron. What I'm seeing more and more is they're not providing compound benefits. So let's say you get a policy and it offers to pay $100 a day. In the past, that $100 would normally compound at 5% a year. Now what I'm seeing is 5% simple interest, things like that. Or now it's only 3% simple interest.
Right.
So what I'm seeing is the kicker on the inflation rate will not keep up with the actual cost of the good or service.
Interesting.
Something to throw out there.
Yeah, that's a great point.
So a couple more things from the blog post. The appeal of combination policies. Aside from the fact that you get something for your premium no matter what, the biggest advantages are as follows, this blog post says. 1, The policy could be a good investment if you otherwise would have spent the money or kept it in a low-yielding account. Do you agree or disagree with that?
I agree with that because I'm assuming it's going to have some sort of investment and generate some sort of return.
On the cash?
Yes, exactly.
I will agree with you on this one. Next one I want to get your feeling on. You won't have premium hikes when you pay with a lump sum. And a policy with a limited number of payments might even guarantee the premiums will stay the same. Some owners of traditional long-term care insurance policies have seen their premiums double within the past several years. Here you go, you alluded to this, as care costs have surpassed insurance companies' projections. And with historically low interest rates, insurers haven't made enough investment income off the premiums to pay claims.
So they're baking it into the price.
They're baking it into the price more. I would agree. Another one. There's a money-back guarantee with some of these combo policies. The insurance company will return your premium if you decide you don't want the policy after a certain period of time. This blog post says, Aaron, such as 5 years. Before then, you can get a percentage of the policy also at different times. So there's that out there as well. Now, I want to get your take on these downsides that they wrote.
Yes.
Okay? This is a combination policy of LTC, which stands for long-term care, and life insurance is probably not for you if, number one, you only need life insurance. In that case, you should just buy regular term or permanent life insurance. Term life is designed to cover the years that your family depends upon your income, is sufficient for most people. Permanent life insurance covers you for your whole life. Any comments? Do you agree or disagree?
I agree wholeheartedly with that, that statement.
Next point, you don't want permanent life insurance if you only need temporary. Shop for a term life policy, which is much cheaper.
Yes.
Agree or disagree?
Totally agree.
All right, one more. You don't have $75,000 or more burning a hole in your pocket. The American Association of Long-Term Care Insurance, there's an association for that, Aaron, says that the combination policies are best for people who have, quote, lazy money, end quote, sitting in CDs and money market accounts. Your opinion?
I would definitely agree with that because for a lot of people, they don't have 75,000, 100K to just dump in to an LTC policy.
Nope.
When they should probably, if they are focusing on saving, it should most likely be for retirement or other things, in my opinion.
I'm with you. I am with you. So last part of this blog post, get advice before you decide. It says, if you do decide on a combo policy, compare quotes from multiple insurers and check the insurance company's financial strength ratings before you buy. It only takes a few moments to look them up on websites of independent rating firms such as AM Best, Fitch Ratings, Moody's Investor Service, or Standard & Poor's Rating Services. Okay?
Great.
Last statement is this. Combo policies, combination policies, are complex products and their cost and benefits vary.
Yeah, I think it's going to come down to the individual person for sure on whether this makes sense for you or not.
I would agree. Yeah. And so my editorial slant with my opinion is this. If you're listening and you have a legacy policy, an old life insurance policy you bought back in the day, and it has a bunch of cash value in it, this is something where if you're concerned about long-term care, you should definitely, you definitely should consider this. Now, us as a firm, this is something we can shop around. I don't want to turn it into a commercial, but it is something that, we can do. It's not a core of our business. Our core part of our business is asset management and financial planning. But this is something we can do. But I want to at least introduce the topic. And then whatever trusted advisor you have in your life, listeners, reach out to him or her. Have the conversation.
Yeah.
Good way of saying it?
Yeah, for sure.
Okay.
That's great.
So before we sign off, Aaron, I'm going to give you the floor. Anything else come to mind about the markets or anything you want to bring up to listeners?
No, not really. Anything you were thinking of?
Well, we're on the tail end of earnings season. So, earnings season lasted from the middle of April to the middle of May. We're at the very tail end. Earnings in general, we mentioned it on last week's podcast, are just blew them out of the water. Stock market seems to not care at all.
I know, yeah. That's kind of been on my mind too. What do you think the reason for that is, if you're speculating?
So in my opinion, I just think a lot of people have been buying these lower quality names. They're speculating on the reopen trade, anything that's cyclically sensitive to inflation, and that's been the hot trade.
Yeah.
And I think ultimately people are concerned about what the Fed's going to be doing about interest rates. Are they going to do a surprise rate rise? I think there's just a lot of uncertainty in regards to what some of this legislation might get passed.
Right.
What are companies going to do with all this cash that's on the sidelines? So, I think that has a lot to do with it.
Yeah, I agree.
Anything else?
No, I think that was great.
That's all I have. So thank you, listeners, for being a part of the 97th episode of the Independent Advisors Podcast. Aaron, thank you for being a part of the podcast this week.
It was great. I was happy to be on it today.
I really enjoyed being with you today. So, listeners, we hope you all have a wonderful rest of the week. And I will be returning next week with Mark McEvely, and we will be recording the 98th episode at that time. So take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.